To save millions of dollars in taxes over your lifetime from real estate you already own or plan on buying? Watch this video to learn how. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise Financial Services, where we're empowering small business owners with tax savings so they can grow and build wealth with confidence. Today, we're going to go over a strategy for the high W-2 earner, as well as the small business owner, as well as the high 1099 owner that is around real estate and owning rental property and the tax savings that can be created from stuff you already own. So you actually might already be sitting on a massive tax savings opportunity and not even know it. Many professionals assume paying tens or hundreds of thousands of dollars in taxes each year is just the cost of success. But if your spouse doesn't work or has flexibility in their income or has 1099 only, you could potentially eliminate your tax bill by using real estate you already own. And especially if you guys have two W-2s and you think, hey, there's nothing I can do, there's actually a loophole around that, which we'll get into later in the video. Now, this is all made possible by combining two powerful IRS-approved strategies, real estate professional and cost segregation. Together, they actually allow you to generate paper losses from real estate and accelerate them, and then use those losses against your W-2. And the result here could save you six figures of taxes in a single year and millions of dollars over your lifetime. So part one to the strategy is qualifying for the real estate professional status, or REPS as it's called. Under normal IRS rules, rental losses are considered passive and can't be used to offset your W-2 income. This means that even if your rentals lose money on paper, mostly due to the depreciation, those losses just carry forward and don't really do anything to offset your tax bill. But when the IRS provides this exception here, if one spouse qualifies for real estate professional, those losses can be active and then can offset active income against the other spouse's W-2 or salary. So to qualify for REPS, one spouse, and just one, needs to qualify by spending 750 hours per year on real estate activities and spend more than 50% of their total working time in real estate. They also, in a separate test, need to materially participate in the management of the rental itself for at least 500 hours or 100 hours or more than anyone else. And that's per rental. Now, there is a way around this. There's a way to group them all together, but there's implications there. If you have a question about that specifically, feel free to reach out to us. Our contact is in the description below. For high income couples where one spouse is full-time W-2 and the other spouse doesn't work outside of homes, real estate professional is often achievable. Once the stay-at-home spouse qualifies and both spouses participate in managing the properties, rental losses can be used to offset W-2 income on the joint tax return. So for example, let's just say one spouse manages their family portfolio of 3 rentals full-time and documents over 750 hours of activity. And then their spouse earns, let's say, high income, like $400,000 as a doctor. Well, because the first spouse qualified as real estate professional and they materially participated, they can use all the paper losses of depreciation to offset the other spouse's W-2 income, potentially eliminating most of their tax bill, if not all of it. And what's even more exciting is we can pair that real estate professional status with the use of cost segregation. So once you actually qualify for REPS, the next step is to actually use that property you already own to accelerate the depreciation. That will get you a much bigger loss in the year that you use it and potentially eliminate your entire salary. So that's where the cost segregation comes in. Normally, residential properties are depreciated evenly over about 27 and a half years, but many components of the home wear out faster, like flooring, appliances, cabinets, or landscaping, and cost segregation allows you to break those out and depreciate them over 5, 7, or 15 years instead, but most of it can happen actually in year 1. And bonus depreciation enhances this by letting you write off most of these shorter life assets immediately. So in 2024, you can deduct 60% of the losses in year 1. 2025, it's actually 40%, so not as attractive. However, there are tax laws currently in motion as of May 19th, 2025, when I'm recording this video, that could bring bonus depreciation back to 100% permanently. So very exciting stuff. Here at TaxWise, we're keeping a pulse on that. Going back to the example here, if your rental property is worth $500,000, a cost segregation might find about $150,000 of short life assets, and you could deduct in 2024 $90,000 of that. That's 60% of the 150 right away, plus in addition to the regular depreciation. And if you qualify for REPS, as we mentioned in the first step, that can potentially save you over $30,000 in taxes in the first year alone. And you can even do what's called a look-back study, which is important, right? Because the theme of this video is folks that have real estate they already own. You can do a look-back study on properties you already own by filing IRS Form 3115 and redoing the change of accounting. You can actually catch up on depreciation you missed earlier and deduct it all in that year. And I will note on the bonus depreciation, 60% for 2024, that's for properties you bought in 2024. So if you bought a property in 2021 or 2022, you're going to use the bonus depreciation from those years. So that's going to be much more attractive for you and definitely worth digging closer into. So when we tie it all together here, let's just create a real world scenario. So let's call this guy John. He makes $400,000 from his job, and then he has his wife Jane, and she doesn't work in W-2 day to day, but manages the rentals full time and qualifies for reps. They can do the cost segregation on the 3 rentals they already own. This study generates $300,000 in depreciation alone. These losses offset W-2 income from John, reducing their taxable income to just $100,000, and this will save them over 6 figures in taxes that year. And this process can repeat as much as possible, right? You can buy more properties, do more cost segregations, get more bonus. It's all the game that the IRS wants you to play in an effort to provide more housing for your fellow American citizens. So that's pretty much the gist of it. Let's go into if spouses both share W-2 or both have W-2. Let's go into the loophole here. It's called the short-term rental loophole. So you can't do this for long-term rentals. You got to do it for short-term rentals, and you got to meet the material participation tests of the properties themselves. You don't need to meet the first part, which was the 750 hours in more activity than anything else in the reps requirement. You just need to individually materially participate in each short-term rental for it to be considered an active business and not a rental activity. And of course, that offsets your W-2 income. Very, very powerful stuff here. When we combine the real estate professional status with cost segregation, high income earners can drastically reduce or eliminate their federal tax liability year after year. Strategy super powerful, legal, and can be used on real estate you already own. So this is new information to you and you don't really kind of understand the ins and outs of this, or you had an accountant that was not real estate focused like we are, feel free to reach out to us in the description below. We're currently accepting new clients and might be able to get you results similar to the example I shared on this video. Thanks so much for watching and have a great day.